Hello everyone and welcome back to TradeSmart. Today we are testing one of your requests, which is TradePro's best performing strategy, to see if it is really that good. Is 80% gain on the account possible within 100 trades? Let's see. If you enjoy my content, show your appreciation by clicking the like button down below. And now, let's see the strategy. The strategy was requested by one of you in the comment section. So if you want to see your strategy tested on this channel, feel free to drop a detailed description or a video reference of your strategy down below. This strategy includes divergence, which I don't like backtesting because it is a subjective indicator and I want to provide you objective, non-emotional strategies. The reason why I decided to give it a go is because I made it as objective as possible. On the other hand, I personally like and use divergence in my trading because it really shows when the momentum is slowing down and the supply and demand is about to shift, giving the price direction a change. With that said, let's go over the rules. For this strategy, you will need two indicators. The first one is going to be the multi-time frame EMA, and the second one is going to be the MACD. You can find the multi-time frame EMA by typing in MTF EMA. It's going to be by FX Mesa. Just click it 2 times. We are going to set the first one to the 1 hour and the 50 EMA period. And we are going to set the second one to the 15 minute and the 50 period. And now let's see what are the rules for a long entry. First, you need to have the 15 minute 50 period EMA, which is the pink line, above the 1 hour 50 period EMA, which is the white line. As you can see, it's here down below. The second rule is that you need to have a MACD divergence below the zero line without touching the zero line. So what is a divergence? A bullish divergence is basically when you have a lower low, as you can see here, but on the MACD you have a higher low, as you can see here. So I will draw a line, you can see it better. The entry candle is going to be the next cross up on the MACD. So for a long entry, you need to have the MACD below the zero line, crossing up, then crossing back down, and creating a higher low, and then crossing back up again, and that is going to be your long entry point. So as you can see, this happens on this candle. The stop loss is going to be 2 pips under the last low, or the divergence lowest price point. So we are counting down 2 pips from this point. 1 and 2. The take profit is going to be 1 to 2 risk to reward ratio, as you can see here, which we hit right around here. So this is going to be a winning trade. Now let's see the rules for a short entry. For a short entry, you need the 15 minute 50 period EMA, which is the pink line, to be under the 1 hour 50 period EMA, which is the white line. As you can see, we are in a bearish trend, so we are ready to set up a short position. The second rule is you need a MACD divergence above the zero line without touching the zero line. So what is a MACD bearish divergence? It's basically the opposite to a bullish divergence. You need the price to create a higher high, but you need to see a lower high on the MACD. So I will draw you a line so you can see it better. As you can see, we have a higher high in the price, but we have a lower high on the MACD. Our entry point is going to be the next MACD cross down, and we didn't touch the zero line, so it's a valid entry. The entry point is going to be the next MACD cross down. We are going to set the stop loss 2 pips above the last high, or the divergence highest price point, which is going to be right around here. And we are targeting 2 to 1 risk to reward ratios, which is right there. And the price just hit our take profit right on this candle. So it's a winning trade. Now let me show you a few more examples of a long and a short position so you can fully understand how divergence works. Here is another short example. You can see we are creating higher highs on the price, but at the same time we are creating a lower high on the MACD. So we had a cross down, a cross up, and the next cross down. Our entry point is going to be on this candle. For the stop loss, we are targeting 2 pips above the latest high, which is going to be here. And we are targeting 2 to 1 risk to reward ratio. As you can see, this one hit our stop loss, so it's a loser. Here is another long example. As you can see, we have the 15-minute 50-period EMA above the 60-minute 50-period EMA. And you can see we are creating lower lows on the price, but a higher high at the same time on the MACD. So let me draw you a line, you can see it better. Here is a lower low. And here you can see we have a MACD cross up, a cross down, and another cross up. And this is a higher low. We are not touching the zero line, so it is going to be a valid long entry on this candle. Stop is going to be 2 pips below the last low. So we are counting down 2 pips from this point, which is going to be right around here. And we are targeting 2-to-1 risk to reward ratio. As you can see, we just hit the stop loss, so it's a loser. I hope everything is clear. If you have any questions, don't be afraid to ask me down in the comment section, and I will be answering it as soon as I possibly can. And with that said, let's see the backtests. And the results are in. If you watched the video so far, don't forget to drop a like, and if you are a new subscriber, click the notification bell so you won't miss my next strategy testing video. Well, as you can see, the strategy had a very bad performance. After 57 trades, I ran out of price data on the Euro-USD pair, and I decided not to go over the full 100 trades. You will see why when I show you the equity curve. It might have been just a very bad performing price data section, but I have an idea about why it performed so bad. After I completed the backtests, I went over to the original strategy video from TradePro and checked out his 100 backtests. Without going over his full 100 trades, I already saw a few entries which he missed. Here are some examples. Here is the first example. I will link down the original strategy backtesting video from TradePro and you can check it out by yourself. As you can see, we are creating lower lows with the price, while we are in a bullish trend. That means we have the white multi-time frame EMA above the yellow multi-time frame EMA. And if you take a look down on the MACD, you can see that we are creating a higher low, while we are creating lower lows on the price. That means it should have been an entry, but as you can see, there are no entries on TradePro's video. Let's take a look at another example. Here on the second example, you can see a winning trade by TradePro. But as you can see, the MACD touched the zero line while creating the bullish divergence, which couldn't have been happened according to his rules. So this winning trade should not have been taken. Here you can see a missed short example. As you can see, the multi-time frame EMAs are showing a bearish trend. The price is creating higher highs, while the MACD is creating a lower high. So this would have been an entry right around here. As you can see, TradePro did not take this entry. Sorry if I'm going a bit too fast over the examples. If you need some time, just pause the video and you can check it out by yourself. Here you can see the fourth example, which is a missed long entry. As you can see, the multi-time frame EMAs are showing a bullish trend. You can see that the price is making lower lows, but on the MACD you can see we are making higher lows without touching the zero line. So it would have been a long entry, which he did not take. Most of these trades would have been losers, meaning less gain on the account. I am not saying that he avoided these trades on purpose. His main strategy includes divergence, and in my opinion, he has an eye to be able to spot a good quality divergence and unwillingly avoid bad ones. But as I took the entry in an objective, non-emotional based way, I got these results. I can say that this strategy can be improved and made into a profitable one by adding different rules to what counts as a good quality divergence. For example, an X number of candles needed after the first MACD cross, because a lot of the losers came from a cross down on the MACD and then an instant cross back up on the MACD. If you want me to test this strategy again on different pairs 100 times or more, or you want me to optimize the divergence entries, let me know in the comment section. Now let's move on to the equity curve. As you can see, this strategy has a slightly negative or no trend at all after 54 trades. Let me show you what a good equity curve looks like. Here you can see we have a steady climb with some normal pullbacks, but this 54 backtest just goes slightly in the positive, then falls back into the negative region. If you think I did the backtest wrong, let me know, because I certainly did not expect these results. That's all for today's video. Thanks for watching. Don't forget to like, subscribe, and hit the notification bell so you won't miss the next strategy testing video. Until then, have an amazing day, stay safe, and see you in the next video.